People's Bank of China announced a cut in reserve requirement ratio by 0.5 percentage points from February the 5th. The announcement came as PBOC officials laid out their plans for the year Wednesday. Han Gongsheng, governor of PBOC, said in 2024, China will adhere to a prudent monetary policy to create a favorable monetary and financial environment for the real economy. He said financial support will increase for major strategic areas and key sectors. PBOC will continue to work to prevent and resolve financial risks in key sectors. As he said, the overall financial risk in China is under control, with financial institutions operating steadily. Pan also said financial reform and opening up will continue.
On the one hand, we will deepen financial reforms. On the other hand, we will steadfastly promote the high-level opening up of the financial industry. We will deepen institutional opening up in the financial sector and expand the interconnectivity between domestic and international financial markets. We will steadily and prudently promote the internationalization of the renminbi. We will continue to support Hong Kong and Shanghai in supporting their status as international financial centers.
PBOC officials also say they will make maintaining price stability with inflation primed for moderate increase an important consideration in formulating monetary policies this year. Sun Ye, CGTN, Beijing.
Okay, it's an important story with obviously a global impact here. To make sense of it all, let's bring in Dan McClory. He is the managing director and head of China for Boustead Securities. Dan, thanks very much. Let's get right to it. It has been a tough 3 years. The market losing about 40% of its value. We're talking trillions of dollars. What do we know what drove stocks to fall earlier in the week, and what really is behind this?
Well, Sean, I think in a word, it's confidence. There is a serious lack of confidence, whether it's with Chinese domestic investors, whether it's with the international community. And as we know, markets rely heavily on confidence. It's not just about policy. It's not just about intervention. But we're missing, and we could use a lot more confidence in the Chinese stock market.
Okay, as I understand it from the market, really nothing drives the price of a stock like earnings. So let's talk about some of the earnings in the market in Hong Kong, and the information that we just heard there coming out of China, focusing on high-level internationalization as well as a real focus on these important financial centers in Shanghai and Hong Kong. What is that going to do for confidence?
Well, I think China's stock market has to internationalize itself. It has to become more market-based. I think for too long, investors have had the perception, or perhaps the reality, that the government is there and you're always going to be safe and you'll somehow get bailed out. But that's really not how markets work. So I think internationalization is a great step in the right direction. It'll bring more market-based principles. These companies that are listed are technically functioning, with the exception of perhaps the property sector, very well. They're not misdelivering. It is the perception, and it is, again, that confidence factor that's really leading to this $6 trillion meltdown that's occurred over the last year.
When you talk about $6 trillion, it just seems like every sector is going to take it to a certain degree on the chin. But what sectors do you think have really been adversely affected?
Of course, property, right? We know China has had its challenges with the real estate sector. Another sector would be some of the tech companies. There's been a correction in many of the tech companies. They've not wanted to create monopolies in China, so the incumbent major players in the tech space have also been hit very hard.
And we also know that state authorities are doing what they can to reassure measures, to reach out to people, not just in China, but throughout the world. But looking forward, what you talk about this confidence, what is it going to take it to get past the hump? The fact that the United States and China are talking once again, how positive could that be going down the road?
I think that's part of it, Sean, because, the geopolitical overtones, not undertones, but overtones here, don't help the confidence. If parties are questioning their relationship, they're going to look at everything. They're going to look at the stock market, for example. So I think an improvement in relations could only help. But let's face it, I think the Chinese stock market has to correct. I think it might have to have perhaps a radical correction and then come back out of it in a market-based way in order for investors, the international community, the companies who list on it to see that this is a fully functional market that's open to all the forces that drive stock markets around the rest of the world.
Boy, you talk about a correction. How much more can investors take? You're talking about trillions of dollars that have been built up over years, even decades, wiped out over the past 3 years, and certainly the government right now doing what appears to be all the right things, saying all the right things, and trying to offer some sense of calm, especially to the global markets.
Yeah, when you say how much more can it take, I mean, things can always go down. We never say it can't get any lower. Sometimes they can, but I agree with you, Sean. 6 trillion, that's a number. So what does that cause? That has caused some observers to say, this is a buying opportunity, okay? If you liked it a year ago, 2 years ago, you should love it now if fundamentally many of these companies are unchanged. So I think there's not much more downside to be experienced, and I hope I'm correct in making that prediction.
Right.
Because 6 trillion, that's a massive number.
It certainly is, and especially we've heard so much about right now with China's economy, a lot of concern about consumer investment within that nation. What does this do to the market and that confidence that you've talked about? Where do you see China's overall economy moving in 2024?
Well, right now they're talking about perhaps 4% growth. But just going back to what's going to drive the stock market to return, as we know, the China stock market is heavily influenced by retail. So connected to your comment about consumers there, it's consumer sentiment. In other developed markets around the world, there's far more institutional involvement, but China's different. It's had a lot of savers who have decided to put money into the stock market with the assumption that things are always going to go up or the government's always going to be there. And then there's been what was referred to as the national team. So a lot of buying on the part of Chinese funds, institutions, perhaps state-owned enterprises, whenever it's been necessary. So I think a combination of the confidence returning, but that starts at street level. If I don't feel good about my personal economic situation, I'm not going to be compelled to plow more money into the stock market. And then that national team getting involved to help things. But I really think a market-based stock market with normal factors that influence markets around the world is exactly what China needs, and I think it'll come back with a vengeance.
Great. Dan, we certainly appreciate your insight and certainly hope you're right there. Thank you again.
Thanks a lot, Sean.